This video provides my suggestions for national and international taxation policy and comments on student loan forgiveness, McDonald's prices, and other related issues. Hello friends, this is Unmasked Truth with Harmanjit Saini, where I provide unique analysis of world events based on the unmasked truth that after surrender, Germany continued World War II clandestinely and became a killing machine. I also provide true news that you will find nowhere else. Based on its 2022 survey on 2021 data, World Population Review reported the happiest countries in the world. The report stated, since 2002, the World Happiness Report has used statistical analysis to determine the world's happiest countries. In its 2021 update, the report concluded that Finland is the happiest country in the world. To determine the world's happiest country, researchers analyzed comprehensive Gallup polling data from 149 countries for the past 3 years, specifically monitoring performance in 6 particular categories: gross domestic product per capita, social support, healthy life expectancy, freedom to make your own life choices, generosity of the general population, and perception of internal and external corruption levels. According to the report, the 21 happiest countries in the world in order from happiest to less happy were Finland, Denmark, Switzerland, Iceland, Netherlands, Norway, Sweden, Luxembourg, New Zealand, Austria, Australia, Israel, Germany, Canada, Ireland, Costa Rica, United Kingdom, Czech Republic, United States, Belgium, and France. Europe is certainly doing something right, far better than America, which is in the 19th place in the world in terms of happiness. A nation's citizens feeling happy is a much better goal than highest per capita GDP. One piece of data that illustrates why European citizens are happier, which I shared in my May 23, 2022 video titled Part 3B Child Tax Credit and Other Safety Net Programs, 1.75 trillion Build Back Better plan, is what McDonald's workers are paid in Denmark compared to what they are paid in the United States. In Denmark, McDonald's employees are paid $22 an hour with 6 weeks paid vacation and have a pension plan. All Danes have free health care. In the United States, many McDonald's employees are paid less than $10 an hour, no paid vacation, and no pension plan. And most frontline workers probably don't qualify for health insurance, particularly at franchise stores. Price of a Big Mac in Denmark is $4.82, whereas in the United States it is $5.81. That's how the same company is exploiting American workers, whereas it is forced to operate under different rules in other countries. No wonder citizens in Denmark are much happier than in the United States because they face much less financial hardship than American citizens. In 2021, McDonald's revenues were $19.2 billion and profits were $4.7 billion. Thus, McDonald's is a very profitable company. Most of its profits are made in the United States because it paid its workers less and charges higher prices to its customers in the United States as compared to other countries. Because of low wages paid to workers, perhaps as high as 90% of McDonald's, Walmart, Kroger, Target, and Amazon employees were receiving some form of welfare benefits about 5 to 6 years ago and earlier, such as food stamps, Medicaid, housing assistance to survive. These companies were making huge profits by charging as high prices to their customers as they could and paying their employees as little as they could get away with. Thus, the government was effectively subsidizing these companies' wages to employees, which subsidies were being used by them indirectly to make huge profits. That should not be so. These companies should not be allowed to exploit American workers. I support the recent state of California initiative called the Assembly Bill number 257, the Fast Food Accountability and Standards Recovery Act, which the California State Senate passed on August 29, 2022. The bill would give a 10-person council composed of 4 franchisee representatives, 4 seats held by fast food worker representatives, uh, and advocates, and 2 seats held respectively by one representative from the California Department of Industrial Relations and one representative from the Governor's Office of Business and Economic Development. So this council would have the authority to raise the industry's minimum wage up to $22 an hour for chains with more than 100 locations nationally from the current $15.50 per an hour. The council would also have the authority to establish safety conditions. Governor Newsom has not yet signed the bill. Hopefully, other states will follow California's lead with their own versions of the legislation. Now, I like 2 recent steps Apple has taken in dealing with its employees and its pricing policies. It has announced a minimum wage of $22 an hour for its employees and higher in some locations, and also increased its compensation budget. That is a step in the right direction. It seems Google and Microsoft are following suit. Google is evaluating its performance evaluation process, which will result in higher salaries. Microsoft plans to nearly double its global budget for salary increases. Perhaps the pandemic and nationwide lack of candidates for job openings had something to do with it. But I hope part of the reason was to share the wealth more broadly with the workforce rather than enrich only the few at the top and pay others only what the market demands. I also like Apple's recent pricing announcements about its newest products. Though the new products have seen enhancements as expected, the prices have not been raised. Apple could do it, raise prices, but it has chosen not to do so. Apple has more than $200 billion in cash on hand and investments. Alphabet or Google has $196 billion, and Microsoft has $132 billion. Just 13 of the S&P 500 companies are sitting on a cash pile of more than $1 trillion. That much cash and investments in hand with a few corporations means that the consumer has that much less cash because these companies have been allowed to become monopolies or duopolies as part of nationwide business strategy to keep them strong to be able to weather global competition. That enables them to charge monopoly prices. But less cash with the consumer means that the consumer welfare is reduced. More consumers are living a hand to mouth existence, and others are accumulating less assets. Less cash circulating in the economy means that the economy is growing less than it could because less cash is circulating in the economy. Therefore, Apple's decisions to not raise prices is a step in the right direction. If Apple's cash pile continues to increase, the company should even consider lowering prices and donating some products to schools or poor families. Alphabet and Microsoft should follow Apple's lead in this regard. Both steps taken by Apple will contribute towards increasing the happiness index in America. Now, President Biden announced a blanket plan on August 24, 2022 for student loan forgiveness of $10,000 for borrowers of federal student loans who earn less than $125,000 per year for single borrowers and who make less than $250,000 per year for married borrowers. The amount of forgiveness goes up to $20,000 for borrowers who have also received a Pell Grant as an undergraduate student. Recipients of Pell Grants come from low-income families. This reduces the regressive nature of blanket loan forgiveness. These are the pros and cons of the plan as I see them. While many needy students took out loans to finance their education, student loans were also heavily abused. Many for-profit colleges were set up to take advantage of student loans, and people were coerced to take out loans and enroll in useless courses. On principle, such people should not be forgiven their loans. However, positive action has already been taken in this regard by closing such colleges. Therefore, such abuse will be minimized for the future. Now, some may have taken out large amounts of loans just to live it up in their college days. However, the limit on the amount of loans forgiven will still leave the excess burden on such students to bear on their own. The prescribed individual and spousal income caps are in the 89th and 93rd percentile respectively of 2021 U.S. annual income distributions, meaning lower, middle, and even still many higher income borrowers will receive forgiveness of the student loans in some amount. I believe the income limits are a little too high. Perhaps income limits of $75,000 for individuals and $150,000 for spousal income would be more appropriate, but no more than 100,000 and 200,000 respectively. As per the White House fact sheet, the income limit of 75,000 will forgive loans of 80%, 87% of individual borrowers. The need to continue forgiving student loans should also be addressed. I believe the program outlined on the White House website, such as reforming student loan repayment plans so both current and future low and middle income borrowers will have smaller and more manageable monthly payments, keeping college costs under control, and to strengthen accountability so that students are not left with mountains of debt with little payoff, addresses these issues well. On balance, I enthusiastically endorse President Biden's plan for student loan forgiveness. It will provide relief to lower and middle income households, allowing them to accumulate some assets as well as raise the happiness index in America. The US needs healthy, strong corporations able to compete globally. We've created some of the best in Apple, Microsoft, Alphabet, Facebook, Amazon, Walmart, Intel, Tesla, and others. But these corporations are under constant threat from global competition. To be able to compete, they must be able to invest in their businesses, which depends on their ability to continue making healthy profits. Corporate bosses are not evil in trying to maximize their profits. They are focused on their businesses, not necessarily on the welfare of the citizens in general. Government has to be the referee in balancing the needs of the corporations with the needs of the citizens. We have allowed monopolies or duopolies to be created in most industries so that American corporations can effectively compete globally. This enables these corporations to charge monopoly prices, which squeezes the consumer out of most discretionary income, leading to a life of quiet desperation for most poor and middle class families. Inability to adequately provide for the needs of their children and accumulate assets for a comfortable retirement. Now, we should not expect corporate leaders to understand the needs of the citizens, lower their prices, make less profits voluntarily so that the consumers can save money to improve their standard of living. Corporate leaders often don't know the life of quiet desperation many in the lower and middle class live because most have not experienced it themselves. Legislators and the government must perform the balancing act by having the courage and the will to act huge and windfall profits, will to tax huge and windfall profits to help the lower and middle classes. On the other hand, when businesses face economic headwinds and struggle to make profits, government usually steps in to help them with investment and tax incentives. So this should be a bipartisan issue. The US needs a paradigm shift. Europe has had it right by focusing on citizen happiness and forcing businesses to toe the line. Government needs to be nimble in assessing the needs of citizens and quickly meeting them by raising the money needed through taxation. Remember, taxes can be raised and lowered depending on the need. A robust taxation policy should not require frequent tax adjustments, however. Nimbleness requires the ability to tweak tax rates annually if needed. Now, allowing businesses to become monopolies or duopolies so that they can make healthy profits also means that business managers and some workers are very well compensated. This means that consumers are being charged high prices which they would not have had to pay if there was strong competition in the market. They would not receive their high levels of compensation if they were not monopolies, duopolies, or 3 to 4% oligopolies. This justifies requiring the rich to pay higher taxes so that if programs are needed to help the lower and middle classes, they could be funded. Now, besides raising the tax rates for the rich, I discussed how tax revenues could be raised by taxing the super rich In my video of November 1, 2021 titled "It's Time to Remove Brahmanism Out of the US Economy by Reforming the Tax Code." Briefly, I propose the following changes to the tax code. Number 1. The tax loophole of taxing annual increase in wealth only when it is realized through sale of assets should be done away with. Unrealized capital gains should be taxed at a minimum of 23%, but slowly moving towards taxing as ordinary income. There is absolutely no good reason to give this increase in income during the year when any special treatment is meted out. Only wealthy taxpayers realize most of the benefits of this loophole, which enables them to get away without paying little or any taxes throughout their life on this increase. It just further increases their wealth and wealth disparity. Number 2. Realized capital gains should be taxed as ordinary income. This means that realized capital gains should not be taxed at lower rates, or at least the realized capital gains rate should be increased from the current 23.8% to eventually be taxed as ordinary income. The reason is that only the super rich are the main beneficiaries of this tax. To encourage saving for retirement, the current lower rate should be maintained only for those earning income below $1 million annually, which is 99.9% of Americans, and net worth should not be a criterion. Number 3. In order to apply the taxes fairly, those private businesses with annual revenues of say 50 million must sell 10% of the value of their stock in the stock market to the public, so that the corporation can be fairly valued by the market. That will enable fair calculation of the realized and unrealized capital gains to minimize the possibility of private firms escaping fair taxes. Number 4. In emergencies or dire need for investment, a wealth tax of 1 to 3% could be imposed for limited duration, such as 2 to 10 years on billionaires. Such wealth tax will perhaps apply once or twice in the life of the taxpayer. These changes in the tax code will result in the wealthiest individuals paying their fair share of taxes, whereas the middle class will pay lower taxes. Now, in the November 11, 2021 video, I suggested that stock buybacks should be taxed at 2 to 5%. My preference would be for the higher rate, as buybacks are made with cash which the corporation thinks it can profitably reinvest, otherwise, or merely to benefit the corporate officers. There is also a need for windfall profit tax on businesses. Here are the 2021 revenues and profits of some of the US Fortune 1000 companies. Walmart, revenues of 55.59 billion, profits 13.5 billion. Amazon 386.1 billion, 21.3 profits. Apple 274.5 billion in revenues, 57.4% in profits. Berkshire Hathaway 245.5 billion in revenues, 42.5 billion in profits. Alphabet 182.5 in tax revenues, 40.3 in profits. Microsoft 143 billion in revenues, 44.3 in profits. JP Morgan Chase 129.5 billion in revenues, 29.1 billion in profits, and so on. Clearly, a large number of companies are exploiting their monopoly or duopoly power. Their perpetual windfall profits indicate how good they have become in squeezing the disposable income of the poor and middle class consumers. Therefore, the lower and middle classes need relief to make life a little easier to live. A windfall profit tax needs to be levied as one of the sources of revenue to finance programs to help the lower and middle classes. I propose the following rates. For profits above 10% of revenue, I propose a 5% of windfall profit. Then for profits above 15% of revenue, I propose an additional 2.5% windfall profit. Then for all profits above 20% of revenue, I propose an additional 2.5% of windfall profit. To illustrate, let's take the case of Apple with revenues of 274.5 billion and profits of 57.4 billion. Assume it pays a 15% income tax on all profits. That tax would be 15% of 57.4 billion or 8.61 billion. Its profit above 10% of revenues is 29.95 billion. The windfall tax on that would be 29.95 into 0.05 or 1.4975 billion. Since Apple has profits even higher than 10% of revenues, its profit above 15% of revenue of 57.4 minus 274.5 into 0.15 or 16.225 billion. The additional windfall tax on that would be this figure multiplied by 0.25, resulting in 406 billion. 0.406 billion. Since Apple has profits even higher than 20% of revenues, its profit above 20% of revenue is 12.862 billion. The additional windfall tax on those profits would be 12.862 into 0.25 or 0.322 billion. Therefore, Apple's total windfall tax for 2021 would be 2.25 billion, rounded up. And Apple's total tax burden for the year would be 10.835 billion. Now, countries implementing a windfall profits tax would face the problem of companies moving their headquarters to low tax jurisdictions to avoid high tax jurisdiction. This leads to a race to the bottom, which is countries minimizing corporate taxes to attract companies to locate their headquarters and operations in the low tax jurisdiction. However, changes in international taxation could alleviate the problem. International taxation of multinational corporations presents much greater challenges than taxation of national businesses, and it takes years of negotiations to reach international agreements on how to tax international businesses. Here are some principles that should guide international tax policies to be fair to all countries in which business is conducted by multinational corporations. It will also alleviate the race to the bottom problem. All governments need revenues to meet government expenditures and provide services to citizens. Some of the most important sources of revenue are individual and business taxes. The individuals pay taxes in countries or counties in which they live and work. Businesses should pay taxes in the countries or counties where they earn their profits. In international trade, products are manufactured in certain countries, whereas they may be consumed in the country of manufacture or in other countries to which they are exported. Determining profits to be taxed is a challenge. Companies will attempt to maximize profits in lowest tax jurisdiction or in the home country in which company is headquartered to benefit its own people. An issue is the transfer prices to be charged to subsidiaries doing business in foreign countries. The most equitable way to determine transfer prices would be to charge costs against revenues from countries where the costs are incurred and not against global revenues. The reason is that the benefits of employment are enjoyed in the country in which the costs are incurred. Perhaps this is best illustrated with a simplified example. Let's say a company manufactures an item in country A only. It sells the item in countries A, B, and C. It has subsidiaries in countries B and C to market, sell, and service its products. Its global sales are 100,000 units of item at $1 per unit for global revenues of 100,000. It sells 50,000 units in country A and 25,000 each in countries B and C. Assume the fixed cost of manufacturing the item is 0.25 cents. Fixed costs are referring to plant equipment and machinery and administrative costs. And variable cost to manufacture item are 0.25. All the fixed costs are covered with sales of 50,000 units. Therefore, all the fixed costs of manufacturing the product should be chargeable to country A, since country A is driving all the benefits of employment and the massive economic multiplier effect that has the economy and GDP. Assume the marketing, sales, and servicing costs are an average of 0.20 per unit, whether sold in country A or in country B and C. Therefore, in country A, the company's profits will be 0.32 unit of sales, or a total of 15,000 from sales of 50,000. Since all the fixed costs have been covered in country A, subsidiaries of the company in countries B and C should be charged 0.25 unit of the variable costs only. They also incur 0.20 unit in marketing, sales, and servicing costs of total per unit cost of 0.45. Therefore, the subsidiaries in countries B and C would make a profit of 0.55 unit for a total of 13,750. If the corporate tax rate in countries B and C is 20%, then the subsidiaries will pay taxes of 2,750 in each country. Company will be able to repatriate profits of 11,000 from subsidiary in each company. Therefore, the company will have total profits of 37,000 in country A, on which it will pay taxes in country A. Remember what countries B and C are realizing is just some increased tax revenue and profits from sales. The corporation in country A are still realizing much greater bulk of the after-tax profits. This form of international taxation will minimize the incentives to locate company headquarters to low tax jurisdiction, but it will also lead to special situations due to corporations cheating to minimize paying taxes in other countries, and the countries trying to tax foreign corporations as much as possible, which they will have to balance against the possibility of driving them out of the country. One special situation occurs when a country manufactures mostly for export, such as garment manufacturers. This situation, however, can be easily handled. The maximum amount of fixed costs should be chargeable to domestic revenues. Any remaining fixed costs could then be charged to export revenues. A special situation would be created by a major exporter not choosing to set up a subsidiary in the importing country. In our example, company manufacturer in country A chooses not to set up subsidiaries in countries B and C, to each of which it exports 25% of its production. Now let's assume this example, that country B is the United States. Company chooses to partner with immigrants for country A to the United States to export its products to the United States. These immigrants want to benefit their country A back home, so they agree to import the product from country A at full cost of 50 cents per unit plus 30% markup for a total price of 0.65 per unit. The importer incurs marketing, servicing, and sales skills of 0.20 per unit and realizes a profit of 15 cents per unit for a total profit of 3,750 on the 25,000 units it sold. It will pay tax on profits of 3,750. If the tax rate is 20%, the importer will pay 750 in taxes to the United States. If the company had set up a subsidiary in the United States, its cost for product would be the variable cost of 0.25 per unit, as it has already recovered its fixed costs. The company would mark up the cost by 0.15 per unit, realizing a profit of 3,750. The company should be required to pay 750 or a tax rate of 20% in taxes in the United States. Meanwhile, its subsidiary would incur 0.2 per unit marketing, sales, and servicing costs, realizing a profit of 0.40 per unit for a total of 10,000 on sale of 25,000 units. At a corporate tax rate of 20%, the subsidiary would pay 2,000 in taxes to the United States. The United States government would realize 2,750 in corporate income tax, but since the company will not have a separate presence in the United States other than its subsidiary, The subsidiary should be liable for the entire 2,750 in taxes, and the company should transfer its product to the subsidiary at its variable cost of 25 or 0.25 gasols per unit, because all its fixed costs have already been covered. In the meanwhile, country A has realized the benefits of most of the manufacturing, employment, and management of the business and the massive economic multiplier that results from it, as well as the additional profits of 0.40 unit, as its fixed costs were already covered. Thus, on export of 25,000 units in the United States, it realized an additional profit of 10,000, on which it will pay taxes in country A. In the worst case scenario, company's total revenues in its home country A was 50,000 from domestic sales, 20,000 from exports, assuming it transferred its products to countries B and C at 40 cents per unit, which included 25 cent variable costs and 15 profit markup. 70,000 was used to pay salaries, other expenses, benefit shareholders, and pay 2,750 in taxes to governments in countries B and C. With an economic multiplier of 3.4 times, countries A's GDP would benefit to the tune of 201,750 to 269,000. Depending on what multiplier you use, 3 days or 4 days. Meanwhile, foreign countries B and C would be drained of valuable foreign exchange of 20,000 pounds dollars for imports. However, sale of imports will generate revenues of 50,000 for a net benefit to the company of 32,750 plus 207,750 in tax revenue. With the same 3 to 4 times economic multiplier, the economies of countries B and C will remain in GDP to the tune of 49,125 to 65,500 each. Actually, the benefit of country A is likely to be slightly greater, and to countries B and C slightly less, as the transportation costs are likely to benefit country. More than countries B and C. In addition, subsidiaries in countries B and C are likely to generate some additional employment for country A. This illustrates between why your essentially A is not grudge paying 2,750 in taxes to confess B and C instead of paying only 750 per some unit in taxes to countries B and C instead of paying only 750 in taxes. Just a reminder, governments in countries B and C also need revenues to meet government expenditures, to implement source of which is corporate taxes. This means that above a certain level of export revenue in a country, say $10 million, the company must be required to set up a subsidiary in importing country. It may use a representative itself and may be taxed as such. Now, governments and companies can be mean about paying taxes to foreign governments. My suggestion is that if your company is caught cheating on taxes, the audit bill should be borne by the company, as well as the interest and fines on the taxes cheated on. Another special situation is created by a large retailer such as Walmart, Amazon, Kroger, Target, and others, who import tens of thousands of items and may deal with hundreds of foreign vendors. Presumably, they have bargaining power and can dictate the prices they pay for the item they import. However, the de minimis rule of exporting more than 20 million by an exporter to the importing country could be applied, requiring the exporter to set up a subsidiary in the importing country and pay taxes as such. There is the possibility of governments charging higher tax rates to foreign corporations as compared to domestic corporations. Hopefully, International trade agreements can prevent such practices. In addition, the government will drive away foreign corporations and can expect similar treatment for its own corporations engaged in exports to the country. Meanwhile, governments usually give tax incentives to attract foreign corporations and encourage investments by them. This should also check the tendency to discriminate against foreign corporations. Thank you very much for watching this video. Please continue to watch my videos, report my articles on important world events, World War III watch, politics, international business, advice on health and medical problems, and much more for in-depth and insightful analysis. Please also subscribe to my YouTube and Facebook channels, Unmasked Truth with Harmanjit Saini, to view and get information on the latest voices. Please do not have the time to go through the full length of videos. They find it more difficult to read the text of the video. However, YouTube does not provide the capability to make the text of my videos available on YouTube. But fortunately, Facebook does provide that capability. So I make the text of my videos available on my Facebook channels, which you can easily copy.